Well, good morning, everyone. We appreciate you all for taking the time to join today's ATRAM market update. To kick things off, I'd like to say that we've greatly appreciated your continuous support throughout these difficult times. Please know that it doesn't go unnoticed. We also hope that these weekly webinars have helped keep you updated and informed with what has been going on in the market throughout these past couple of weeks. We sincerely hope that you continue to tune in. Now, as we slowly head towards the end of the week, we thought this would be a good time for a one-on-one with ATRAM's Chief Investment Officer, Mr. Phillip Hagedorn, who can help us update us on the latest news and insights surrounding the market. However, before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. We will get to the questions at the end of the discussion. Additionally, please note that we will aim to keep this call at around a half hour in length. I'd also like to let you know that this webinar will be recorded and that copies will be disseminated as soon as possible, as well as posted on all our social media pages. Let's go ahead and kick things off with our Chief Investment Officer, Mr. Phillip Hagedorn.
Thank you, Santi, and good morning to everybody that's joining us today. Again, a real pleasure to be here, and hopefully can share some of the insights that we're looking at and reviewing to see how some of these forecasts will impact markets in the coming weeks and months ahead. So just to kick things off for today, I'd like to kind of start with a more macro outlook first, and looking at the economy. So in the first slide, I think you'll see our forecast for GDP growth for the Philippines for this year. We originally started with a forecast of about 5.9% GDP growth. That was actually already revised lower post the Taal event we had earlier this year. And then as the current crisis hit, the COVID crisis, we've adjusted our base case scenario down closer to about 3% growth. Now we're working with new information, and I think with most economic forecasts that are out there today, they primarily revolve around how long the quarantine period will be. The engine of growth and of businesses is revenue, and revenue right now has been zero in many cases because of the quarantine situation. So with the latest information we have, we expect quarantine to be lifted sometime in May, but this won't be regular programming, as they say. We expect a very slow pickup in mobility beyond May. But our forecasts are that we will get more mobility, less stringent quarantine measures starting May, and which will allow revenues to start to flow again. With that in mind, we have a forecast now of closer to 2.6%, possibly even going to 2% if there's any extension to the now announced 2-week extension. You'll see from the chart on the right, though, that in almost every scenario we have, especially the current one, which is a 1-month extension, we will see negative growth for GDP in the second quarter. And the question is, can we bounce back from that? And I think we can bounce back from that, but how quickly we can bounce back from that is a question we're trying to answer as well. So we are, as you can see from the chart, the recovery is V-shaped. Right now, we are looking at still being quite optimistic that we can achieve north of 6% GDP growth by the second half of next year again. But I have to caution that much of this is determined or will be determined by the length of the quarantine that we experience and that is ongoing today. The next slide. You can go to the next slide, please. Other issues that we're still contending with because we're not completely out of the woods. Clearly, as we ease restrictions on movement and quarantine, we will expect that people's activities will still be quite restrained. We expect social distancing to continue to be the norm for a while. And this is going to effectively slow the recovery a little bit. We had a call with Cebu Pacific earlier in the week, and it's clear that they feel they are hopeful that they will be flying again by sometime mid-May. But they feel that most likely it'll be only 20 to 30% of the routes. And that's likely to be the scenario as well as public starts to move around and congregate in the usual areas such as the malls. No? There is risk of OFW remittances slowing significantly on the back of an oil crisis in the Middle East, with oil prices hitting pretty much all-time lows or all-time recent lows, back to the $20 range. We also know that many seafarers have been out of jobs for a while. 22% of our OFW remittances come from seafarers, so that's expected to be very light as well. And the U.S. still fighting this market, but the market's still seemingly upbeat, but fundamentals deteriorating very quickly there as well. So something to look out for. In the Philippines, I think we're lucky that oil prices are low. So our stress on the peso and currency for imports is not going to be as significant, and thus less impact on inflation as well. We have to, be wary about the distress that's going to be caused on many multinational companies, local companies that are really stymied right now and cannot generate any revenue because of the quarantine. And we also understand that the runway for them in terms of cash flow or cash to support these businesses is not that significant. So it is going to be crucial that the economy can start to make its way back within the next month or two. And that's going to be very important for us to then realize some recovery in the fourth quarter and hopefully stability and normalization into 2021. Next slide. What we can count on is the country is in a good position right now. We mentioned this before. We have our largest reserves ever, right around $87 billion in reserves. Our reserves exceed our foreign debt. Our debt to GDP ratios are still very low or are low and allow us to take on some debt if we need to. So, I think from a balance sheet perspective, and this is a theme that we are really discussing and studying with our equities team is, we want to invest, and as well as the fixed income team, because debt is in the same boat, that we want to be investing or lending money primarily to countries and companies that have strong balance sheets at this point. We're willing to give up return for quality. And I think that's a key message for today as well. Next slide. We're going to go, I think, into the different asset classes now and just give you a feel of what we're thinking or what we think the opportunities might be. So on the equity space, the Philippine equity space, as I mentioned, we want to concentrate into high quality, large cap stocks for our key portfolios or key strategies in terms of the funds. But we also look at companies with very strong balance sheets because we, as you all know, we do have a small mid-cap fund in the Alpha Opportunity Fund. And this company will not invest in large caps, but will invest in medium and small cap companies with very strong balance sheets that we think will be important for defense at this point, but at the same time, allow them to thrive once this crisis is over. Valuations, we want to take advantage. The hard work that needs to be done is determining earnings because we think there's going to be a big hit in earnings this year. The next slide, I think, caps that out and shows that. If you can put the next slide out, we're looking at minus 3% GDP, earnings per share growth for this year. Originally, in the beginning of the year, we were looking at about 11 to 12% earnings growth, sort of matching where last year was. So to put this into context, last year's earnings was, for many companies and primarily the large caps, probably the record profit year for many. We think that if for this year, earnings will drop by 3%, that is not the end of the game. That is not the end of the world. It is a consolidation because of what's going on. But those that survive this year are poised to thrive in the coming years. And so today we are looking at a significant downgrade. So it's going to have a significant adjustment on PE multiples. But not catastrophic as June Tarabaga, our equity manager, would put it. This is not catastrophic. So people and companies will bounce back from this type of situation. Again, we are putting into our forecast just maximum of a 2-month quarantine period and then limited mobility moving forward. And so we hope that that continues to be the case. We're looking at different sectors that we think will be severely affected or slightly affected or not affected at all. These are the sectors on the right here, and it's clear that looks like the telco sector and some conglomerates might be the least affected. Power and utilities, although slightly affected, are also feeling the brunt because power costs are very low. But generally across almost every other sector we cover, we think the effect on earnings is going to be negative. So those are imputed into our numbers today and into our strategies. Next slide gives you a peek into our funds. So a little bit more detail here. So we are walking the walk and talking the talk, as they say. The first column is the Equity Opportunity Fund. Today, that fund is 90% invested in equities with just 10% in cash. Clearly, the top 10 holdings make up 76% of this portfolio, very blue chip led, best of breed with strong balance sheets. Performance so far year to date, it's not been superb yet, but we feel that this rebalance is going to put it in a good position to outperform when markets recover. Our strategic growth strategy, Soldivo Equity, you'll see very similar top 10, except we do include non-index names in this portfolio in a bigger way. And 2 of them are in our top 10 with Axelim and 7. So this is the top 10 holdings of our Soldivo Strategic Growth Equity Fund. On the Smart Index Fund, again, the quant factors that we're monitoring for this are pointing to an overweight in the sectors that we think will be very slightly or negative or neutrally affected by COVID. So you're seeing an increase in weight in the telco space, in the utility space, and in the holding companies. Today, that fund has 9% in cash, 69% concentrated in the top 10 and outperforming the index by 2.5 basis points. Our balanced funds equity strategy is very similar to PHSE, using the quant factors. Today, that group only represents about 26% of the balanced fund. And so there is room for increasing equity space in the balanced funds, and we'll look to take advantage of the current situation to phase that in a slow way. The Alpha Opportunity Fund, these are our top 10 holdings, making up 80% of the fund today. Again, companies we think that will come out of this stronger with a big opportunity. Like I said, these are not blue chip companies as far as the index are concerned. They're not in the top 30, but certainly the large companies and best of breed in their own specific field. This fund is also outperforming its own benchmark by about 3.6% so far year to date. The Asia Plus Opportunity Fund, the equity fund invested in Asia, is trying to capture returns of the MSCI Asia ex Japan strategy. This strategy is invested across Asia via ETFs. Today, 2.5% alpha versus its own benchmark. And finally, our multi-asset strategy, the Optima UMA Global. This is a multi-asset strategy that we're offering now. Again, performing quite well versus its own benchmark with quite significant amount of cash and cash equivalents, a very low exposure to equities at this point, but looking to add to that in the near future. So this is how we're positioned as far as our equity and multi-asset funds are concerned. The next slide, we'll talk a little bit more on fixed income. And on the fixed income space, we are expecting a few things. First thing is that rates will continue to go down. They made a significant move yesterday. Rates came off in a big way, around average of 40 to 50 basis points. And we expect them actually to continue to come down through the year. Maybe not in the same speed that they came down yesterday, but certainly rates will continue to come down. So we will maintain our long duration strategy against the benchmark for our total return strategy. And as far as selection, when we look at lending money to either countries or companies, we prefer lending money to countries right now, those that are stable with strong balance sheets. But we will also look at opportunities on the corporate bond space where we feel maybe there's been some mispricing happening over the last few days or weeks. Next slide. This gives you a picture of our model portfolio versus the benchmark, and you'll see significant amount of weight. We're talking about over 70%, close to 70% of the portfolio invested beyond 7 years. In both cases, our benchmark strategy and our total return strategy really overweight duration here. And we have taken advantage of that yesterday. I think we got some good outperformance yesterday from our total return strategies, the fund strategies, and we expect that to continue as rates continue to come down for the year. Next slide, please. So this is the scenarios we're looking at. As of today, the BSP has cut policy rate by 75 basis points and the RRR by 300 basis points. So we're closer to scenario where we have a probability of 25% actually. The 10-year is now trading at 425 from 480 just a week ago. And we do see scope for a break of 4 and even into the mid 3% range level, assuming that there's a further cut in RRR and possibly another cut in the overnight rate. So again, the expectation is for rates to continue to move downward in the Philippines. Next slide, please. For our multi-asset strategies, please go to the next slide. what we've done is move to what we call capital preservation mode, where the focus is on fixed income and liquidity. We have minimum exposure to equity, although for strategies that have tactical allocation to equities, we are still exposed to equities, but it is a minimum. We are looking at what the indicators will be. We're studying our own factors there to determine or help us determine when we can start to add risk onto the portfolios again. By this, I mean adding equity exposure primarily to these portfolios. No? Again, today we remain positive on Philippine equities, Philippine fixed income. That's our largest overweight, and alternatives expressed by our investment in gold. So if you look at the next slide, this is what the portfolio strategies look like today. Generally, a multi-asset strategy will have minimum exposure to equities. You can see from our moderate strategy here, we're at about 10% total equities, split 5% global and 5% local. We're looking to add to that, still remaining defensive and underweight equities, but we're looking to add weight to the equity space in the next move. Beyond that, moving more towards a strategic weight, we'll have to wait for more normalization. Our expression today for multi-asset strategies are expressed by a total return on Philippine fixed income. We're buying beta index funds for equity for now, sticking to global dividends for our global equity exposure, total return dollar strategy for dollar, and maintaining our alternatives in gold. On an income strategy basis, this is a multi-asset income strategy, so it does have exposure to equities, and it has volatility aligned with it. So just to be clear, we are at a 20% equity exposure level today, looking to bring that to closer to 40% before reaching its strategic 50-50 asset allocation. We're going to do this again for both cases. There's no rush. We will ease it into the portfolio as we see things that we want to see materialize. This is having to do with, one, the infection rates and control of the virus, two, the mobility of people, and as people can start to move, revenue will start to move, and three, as we get a better handle of what the fundamentals tell us with regards to macro prospects and micro prospects for companies, specifically with where earnings will go for those companies. So there is an opportunity to add risk, but we don't feel we need to rush into it. We can progressively add risk over a period of time as we see the environment improve. I believe that's my last slide for the presentation deck, and certainly be open to answering any questions that might come from the floor.
Okay, thanks, Phil. Yeah, so what we're going to do now is open up the floor to a few questions from the audience. Again, you may ask questions through the discussion by clicking on the Q&A button on your screen. Please keep them coming. All right, Phil, I have one over here. I think it's a question that we all would really want to know the answer to. So how does the extended ECQ or enhanced community quarantine affect the local market?
Well, I think that I'm looking at it positively. I think this is what we expected. I think that it's a practical move from the government point of view. The key here is to as much as possible control the more than likely bounce in the infection rates we're going to see once quarantine is lifted. So the government just needs time. They need time to prepare medical facilities, which are being done. Places like the PICC and Rizal Memorial Coliseum, if you've seen are being readied to anticipate this bump that we're going to get once quarantine is lifted. So I think it's just buying time for the government. And to me, the worst case scenario is you reduce quarantine or you lift quarantine too early and the infection rate spirals. So if there's some data out there that we've seen from UP talking about the rate of infection. And, right now we're running at about, for every person infected, it's ×3, could be as high as ×4 or ×5. The hope is, and it is possible with both government measures and personal rules that everybody follows, to reduce that infection rate once quarantine is lifted to 1.5 to 2 times. If we do that, then we begin to flatten the curve. And so there's going to be some areas where the more marginalized are in NCR, where living quarters are much more tight, that the infection rate will be higher. And there's those that can be controlled and be much lower. So the idea is to try and keep this low. So I think the markets reacted quite positively to that news, considering how it reacted to a quarantine news 3 weeks ago, where we lost something like 30% in 2 days. So far, the news was announced yesterday. The markets are behaving quite well. Yesterday, our market was actually up slightly. We're giving a little bit of that away today. But in my mind, we're in this consolidation mode where we will maintain sort of between the 4,800 and 5,600 level over the next few weeks until there's more clarity on how we're dealing with this infection rate.
Okay, thanks, Phil. We've already seen some rallying worldwide economies, especially from their bottoms. Do you think we've already seen the bottom in the Philippines? And would they be following this rally as well?
Well, I wouldn't say we're seeing economies rally. I think what is rallying are stock markets. Stock markets have rallied. Obviously, the sell-offs were very panic-induced in many cases. So for us to hit the 4,000 level, I think I'm not sure fundamentals support that level. I think fundamentals probably support a level closer to 5,000 to 6,000, depending on where earnings are going to fall. So we will see these bounces. We're likely to see more bounces upward in the next few weeks and months. But we are still cautious about where the economy and where valuations will go because of the impact, the longer term and medium term impact of this. The companies are literally working on 4 or 5 months of cash reserves until they're depleted. So for now, if we're just last 2 months, then that's the best news and we can recover sooner. And if that's the case, I think we have seen the bottom. I would expect us another test of sort of our 4,800 level over the next few weeks. I think that might be driven by more foreign market action rather than the Philippines itself. But again, I think we're in this tighter range now. I think there's more sanity in the markets. There's less panic. And the more work we do on trying to forecast earnings, the more stability I think the market will see, because certainly we're not the only ones doing that. And as investors see where there's value, people will start to buy with more conviction rather than buy for today and sell for tomorrow type attitude, which is what's been happening.
Okay, thanks for that, Phil. Let's move towards fixed income a little bit. Is this the perfect time to invest into fixed income?
Well, it's always a perfect time to invest. You just have to be active. So if you're looking at investing in the total return bond fund, I think our guys are very, very active in the market and have made the right calls. Where our view is that rates will go down, and if they do, you're going to make some good money in total return. So yes, it is a good time. It's probably our favored sector today. It's the most likely scenario where you can make money with relatively low risk compared to the other asset classes today. So if I had to choose one, if I had one to pick, I would certainly pick fixed income. And if I had one strategy to pick, I would certainly pick total return.
Okay, thanks, Phil. Do we see any systemic risk since the economy has been put in a freeze, I guess, meaning the ECQ? And what is the worst case scenario for the Philippines?
Well, the worst case scenario is very bad. I just think that, including the government leaders, there is a major push to get the economy rolling again. The key there is to be able to manage the infection crisis, the virus crisis, while the economy gets back on track. There's a lot of data that we're looking at. We had a call this morning that's saying that, the experts of experts are saying effectively 7 billion people in this world are going to get infected. We only have 7.8 billion population. So 90% of this world is going to feel this thing. That's the one view. Now, the question is, can we control that? Can we lower the death rate? Can we avoid, can we manage people getting better sooner? If you know that you have COVID early enough, can we treat it so that it doesn't get worse? I think I just don't see a situation where we will kill the economy completely. I see a situation where the economy starts getting back on its feet. The country is quite well equipped to withstand a few months of support. But are we able to manage the health crisis or potential health crisis that will ensue? And that's why the government needs time to prepare. And that's what these next few weeks is about. Time for test kits to come in, time for medical personnel to be prepared and readied, venues for people to be tested and venues for people to get better and isolate these folks. So, I'm optimistic that we will get out of this. I'm actually optimistic that the Philippines actually went the right course by calling quarantine very early. A lot of people are very skeptical about our numbers, but our numbers are our numbers. It's likely to be much higher than that when we start testing, but we need to anticipate that, expect that, not get shocked by it, but see that we have mitigated it and we have processes and plans in place to mitigate the growth. So that is going to be what the next 3 or 4 weeks is going to be about.
Okay, thanks, Phil. I think we have time for one more. Okay, so the Philippines approved fiscal stimulus is around 1.5% of GDP. Do you feel this is sufficient to get the economy back on track?
Well, it's sufficient for now. For now, meaning for the next 2 months. I think Treasury and the Budget Secretary have said, we have 300 billion. This is good for 6 months. Maybe not, maybe 3 months. But That's why it's important to get the economy back on track. We cannot exhaust our reserves. We cannot exhaust all the cash we have or just continue to print. Although we have ability to borrow, we need revenues to start flowing again. And when we do that, I don't want to reiterate it enough, we need to see that we can control the spread of the virus. And if we can do that, then I think we'll be out of the woods sooner than most other countries.
Okay, great. Thanks, Phil. I think we can leave it there for this call. I think we went a little bit overboard on time, but I hope that's okay. Thank you once again to Mr. Hagedorn and as well to all our audience for the questions. If you have any further questions or would like to learn more about ATRAM strategies or products, please get in touch with your relevant ATRAM relationship manager. Lastly, a recording of this webinar will be released to all of you, as well as posted on all our social media pages shortly. We appreciate you taking the time to join us this morning. And on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe and have a great weekend ahead.